Welcome, MLS listing subscribers, to another episode of Statistically Speaking, brought to you by Aculist. I'm Mark Messimer, the Director of Outreach Services, and joining me today is the Director of Product Management, Tom Durezzo. Tom and I are going to be meeting and discussing economic topics with Jordan Levine from the California Association of REALTORS. I think you're really going to enjoy it. For those, and I can't believe nobody, there's not anybody in our audience that doesn't know you, but I'm going to go with somebody. They just started real estate and they're going, who's this Jordan guy? Um, Senior Vice President, Chief Economist for the California Association of Realtors. Um, what else should we know about Jordan Levine, man? How did you call yourself a numbers nerd? I've seen
Yeah,
your LinkedIn site, but you've been doing numbers, just I read your LinkedIn review. I mean, 10, 20, 30 years now, you've been playing with numbers.
yeah. No, I started out life as a economics consultant, so I did a bunch of random work to pay the bills and had a variety of clients. One of the clients that we worked with was the California Association of Realtors, and just personally, my dad was a realtor turned real estate developer and all of that. He didn't even graduate from high school, found success in real estate, and actually,
Wow.
I credit a lot of my success to home ownership. So I'm like found that perfect intersection where I get to do my nerdy stuff, but shill for home ownership, which I truly believe in. So it's a match
Right.
made in heaven.
I would imagine your Thanksgiving dinners were like my Thanksgiving dinners, where we had a broker and a couple of real estate agents and an appraiser all.
Praiser, exactly. Yep.
Yeah. Um, well, welcome. We really appreciate you having here. I think I've seen you speak many, many, many times before at the associations, large groups, small groups, but here with MLS listings, we try and just have an interaction with our subscribers, and we're hoping that folks, as you hear Jordan talk, as you hear the dialogue take place, if you've got questions, put them down there. In that questions area in the Q&A section. Michelle Ronco is back there in the background, sort of combining and squishing all of the questions together, so we try and solve everyone's issue. Tom, you're going to go ahead and start this dialogue with a question on the general marketplace, I believe.
Well, yeah. So Jordan, our agents are always interested in hearing, not only how to interpret the recent past, but also what does your crystal ball say about what's coming up? And what do you see as, the biggest opportunities and challenges for real estate agents in California?
Yeah, I think there's a lot of challenges. That's probably the easy stuff to focus on. That's the stuff that's top of mind. And I think, we personally care about the macro economy, right? Because when the economy is doing good, there's more transactions and all of that stuff. But I think, more importantly and like immediately, this stuff's really top of mind for the buyers and sellers out there. One of the things that we've been messing around with recently is kind of looking at, different form usage and stuff like that, and how, can we get a beat on what's coming down the pike? And one of the things we've started looking at is stuff like how can we gauge cold feet? We're looking at withdrawn offers and stuff like that as a percentage of the market. And we've seen that this kind of like current event driven, cycle that we're in, ultimately kind of causes people to go into a wait and see mode when there's more uncertainty, when we don't know what's going to happen with rates or with the trade war or what's going to happen to the stock market and things like that. Then you get a lot of people kind of pressing pause. So I think that's a challenge, obviously, because you got a lot of buyers that are going to kind of pump the brakes or get scared or whatnot and want to sit on the sidelines for a little bit. But I think it's also an opportunity in the sense that like we can be reminding folks that housing's a long-term game. You're not trying to buy low and sell high and do all that kind of whiz-bang financial stuff with your home. It's an investment, to be sure. It's one of the only ways actually that people accumulate any wealth, but it's a long-term game, right? So the economy goes up and down and all of that stuff, but you're going to pay to live somewhere no matter what. You're paying your landlord's mortgage probably already, right, for them. And so I think it's an opportunity to refocus folks away from the current events and more towards like what do you get into housing for, right? And what are the benefits to home ownership? And actually, interest rates are not that bad. They're just worse than what they were, but they're actually pretty normal. And so I think there's a lot of opportunity that comes along with all these challenges.
So, uh, did you have slides that you wanted to go through, or
I have some slides. I always, I'm a
You,
slide guy. So if you want to
yeah,
look at some pictures, I can show
yeah,
you
go
some
ahead and
stuff.
line those up, Jordan. I mean,
yeah.
for those of you who have not seen Jordan's slide deck, you must have a team of statistical elves down at C.A.R. creating stuff for you because your stuff is fantastic.
Yeah, thank you. No, I'm lucky to have a great team that really sets me up for success. I can really take almost none of the credit, but it always helps to look at some pictures because this is kind of one of those things that I was mentioning. The overall headline GDP number, which is our econ nerd way of saying, economic growth, it was negative. It was the first time the economy's actually shrunk since the end of the downturn. And you've got a lot of people freaked out by this, negative 0.3% that we had in the first quarter of this year. Not a huge decline, but I think more the kind of psychological effect of just it not continuing to grow the way it has. But I think when you kind of peel back the curtain of that number, you see that it was mostly negative because there was this kind of preemptive purchasing of cars and heavy equipment and things like that in advance and probably in anticipation of the upcoming trade war. And when you strip that away, which is what I'm showing you here in the orange and the gray, actually strips away the imports and the kind of big deep federal government cuts that we had during the first quarter, the Doge effect, if you will. When you take that stuff away, actually, domestic demand is still pretty strong. The challenge, though, is that, a lot of that stuff was a one-time surge in, long-term purchases that we probably won't do again in the next couple of months. You only buy one car every few years. You only buy one backhoe kind of a thing. And so when you take that stuff out, it does seem like there's probably going to be some weakness in the overall macro economy coming down the pike and probably won't be able to hang on to this consistent 3-4% growth that we've been enjoying up to this point. And of course, a lot of people are still waiting on rates. And actually, we got another week of data just this morning, and the interest rate went up to 6.85%, I think is what last week's Freddie Mac number was. Ultimately, though, I think the takeaway is that interest rates just really haven't changed much at all over the last 3 years. In fact, today they're slightly higher than they were before the Fed even did the first rate cut. And we're 3 cuts in. Mortgage rates haven't changed, and that's because regular folks don't get to borrow at the Fed funds rate. We're so hyper focused on the Fed, but actually we have to take into account not just where the Fed sets their target interest rate, but what the bond market is doing, because we have to take into account time value of money. We're not borrowing overnight, which is what the Fed funds rate represents. And on top of that, there's private sector risk, which we like to call a mortgage rate spread. But that's why you don't wait around for the Fed, because again, we're 3 cuts into this and rates are higher now than they were before the first cut. And when you kind of extrapolate out what could happen to the bond market, being fairly generous about where mortgage rate spreads can go, and it's hard to come up with an interest rate that's sub 6%. Forget this year, but even next year and the year after, I think that's kind of the low watermark. And I kind of called this presentation the signal versus the noise, because when you look at the underlying economy, we haven't had much significant real deterioration. Retail sales, which I'm showing you here, was at an all-time high in the first quarter, despite the uncertainty and all of that stuff. If I showed you jobs or unemployment, you would see a similar story, right? That we're basically at all-time highs from an economic standpoint. And yet, all of this uncertainty has caused people to be really worried, right? We spent more than we've ever spent before, but we're at 2008 financial crisis levels of consumer confidence, right? And so the challenge is that the psychological impacts start to bleed over into the real economic data. And you can see that although we haven't cut a ton of jobs, we have started to pump the brakes on filling open positions. And so again, this kind of public zeitgeist can bleed over and metastasize into real economic challenges ahead. And I think one of the places that we're going to see additional turbulence is in the stock market. This chart is showing you 150 years of stock market value over stock market company earnings, right? So this is how you evaluate an asset. What's it cost me to buy the asset? how much income is that asset generating? That's the same thing you do for like a rental property or something like that. The stock market is pretty high relative to earnings. And I think that the longer this uncertainty goes on, we have a 90-day pause on the trade war, but if it ramps back up, we're exposed here a little bit. And this has the potential to further erode, public confidence in the broader economy. But I think the more nuts and bolts aspect of this is, and to get it to return to normal, it would take some pretty deep corrections to the stock market to get back down to this kind of traditional average of about 15 times earnings. But the thing that I think matters more so even than the psychological effect of a stock market correction is the fact that California housing is super dependent on solid stock market performance. When the S&P 500 has gone up, this orange line goes up, you see a big explosion in 2 million and up home sales, which is, a lot of parts of LA and the Bay Area and Southern California and places like that. And conversely, when the stock market's struggling, you see big contractions. And this matters a lot from just a pure transactional standpoint because the top end of the market's the only part really that's been growing over the last year or two as rates have gone up. And that helped us last year because the stock market did really well. This year, there's a lot more volatility, and that has the potential to kind of negatively impact my forecast, shall we say, or it makes it that much harder to get back up to that 300,000 unit level. And you can see that here in the transaction numbers. This is statewide, but if you go back to the fourth quarter of 24, we were growing by 15-20% on a year-to-year basis and making really solid progress towards that forecast that we had for 2025. But if you look at what's happened from January onward, we've really lost a lot of momentum, both because of the fires in Southern California during the first couple of months of the year. And now with all of the stock market volatility and economic uncertainty, the market has cooled even further. And I think, again, we can do a lot of good by connecting the dots for folks and getting them less short-term focus, more long-term focus, showing them that rates aren't poised to change, contrary to what their brother-in-law keeps telling them about a 3% rate being right around the corner again, and all of that stuff. But you can see that the kind of psychological stuff is impacting the housing market, even though all the economic data is at an all-time high level. These sales are plateauing and kind of losing all momentum of late. And a big part of that is that the top end of the market is no longer growing so much that it's canceling out the declines under 500,000. Right. And you can see that it's a narrower and narrower sliver of the market that's actually growing. Currently, it's only 5 million and up, whereas it used to be everything over 2 million was really kind of contributing to that double-digit increase that we were seeing towards the end of last year. Inventory has gone up, but you got to make sure the buyers don't get confused that this is a buyer's market. We're up from 1.5 months of supply to 3.5 months of supply, and that is more than double where we were back when rates were at 3%. But outside of that kind of once in a lifetime period, these are pretty still tight supply numbers, which is why we continue to get ongoing price growth. That being said, though, prices have moderated as you get a little bit less demand and a little bit more supply. We're no longer getting those 10% increases year to year in prices, and prices have started to grow in that kind of moderate single-digit level before. The reason why I don't think there's going to be a ton of foreclosures, and that even if the worst case economic scenario materializes, that it may not drive a flood of distressed inventory or even regular inventory. And that's because a lot of people are still out there in sub 4% mortgages. In fact, 2/3 of California mortgage holders have a mortgage at or below 4%. And so even if you lose your job, even if bad economic stuff comes down the pike at you, you have a strong incentive to stay in that house. That's kind of one of our main saving graces. We also have about 98% of mortgages that are still being paid on time in California, which is a big positive. But I think the real backstop is the fact that about 90% of California mortgage holders have at least 30% home equity, meaning that they can withstand a bit of a worst case scenario. Even if prices go down a bit, that doesn't turn into the wave of foreclosures and REOs that we saw back in 2008, 9, and 10, because you simply just don't walk away from an asset that's worth more than you can sell it for or that's you can sell it for more than you owe on it, right? The other thing I think that really saves us this time around is that we got a lot of homeowners that own their homes outright. So those mortgage numbers that I just showed you, which are already pretty solid, only reflect, 2/3 of homeowners. The other 33%, aren't even exposed. And those folks really don't dump properties when things go sideways on them. And one of the main reasons why I think we can convince buyers to still buy and get them focused back on the long term is because California's got a really strong economy, but we do not build housing in this state anymore, and that is why prices only ever go one way over the long term, and why the number one best time to buy was a long time ago. The second best time to buy is as soon as you can, right? Because we built way more homes back in the 1970s when we were half the size that we are now, and you can really draw a straight line from the fact that we're about 12% of the U.S. economy. But we're only ever about 10% in a good year for U.S. residential construction, to explain why we've got a $900,000 median price and all the other affordability and homeownership challenges that we have. You can very quickly, if we were 12% of U.S. residential construction, we would have built a few million additional units by now. And again, this is why we're behind the 8 ball when it comes to housing affordability, and why waiting doesn't mean saving a bunch of money in the future. Housing pretty much only ever gets less affordable as time goes on, barring some kind of economic catastrophe. And you can kind of see that in this chart, right? If you look at the transaction numbers by price point in California, there's just not blue and orange left to be found, right? You can't find sub $400,000 homes anymore, because the supply constraint that we just saw has caused all of the housing inventory to graduate into increasingly high price segments, right? The 500s are now 700, the 700s are now a million, et cetera. And you end up with more and more of this chart being green and navy blue and whatever all these other colors are. And that is ultimately why housing is not a short-term game, and you want to get your foot on that property ladder and start reaping those benefits. In terms of what the agent should be taking away, I think, on the economic front, there's going to be a lot of uncertainty. You should probably be prepared for interest rates to not change a lot. But I think that's also even more the reason to get folks thinking long term, and how waiting 5, 10 more years is going to be a big self-inflicted wound when it comes to getting your foot on that property ladder. I think when it comes to the transactional side of things, right, buyers need to know that it is more advantageous. There's more supply. The market's not as hyper. But you can't come in and name your own price and expect all these concessions and a free roof and a solar payoff and a rate buy down. It's shifted a little bit away from the seller, but it's not a buyer's market still. Similarly, I think you got to manage expectations on the sell side. It's a great time to sell still, and homes are selling quick, and all of that, and prices haven't budged, right? But you just got to be more strategic than you were able to get away with when rates were at 3%, right? So you got to probably do more on the pre-listing side, on the marketing side. You might have to hire a professional photographer, do some staging, all the stuff that maybe wasn't as important when we had that white hot 3% driven home buyer demand. That means, though, I think that I'm optimistic for job security for real estate professionals, because consumers really need you. There's insurance, right? You got to figure out how to get your offer to stand out from the rest and get accepted. There's a litany of shenanigans at the local level in terms of regulations, and you just need like insurance people, contractors, right? Like all the whole bag of tricks to get these deals through escrow and actually into a closed transaction. But that just means, I think, that we really have got to step up our game, make sure that we're in touch with the data and have responses to all of this uncertainty and cold feet, showing them the long-term benefits and all of that stuff. But I think if we do that, these challenges really are all opportunities almost universally. So that was kind of my prepared remarks, but we do see the market getting better. It's just not going to get better so quickly that you can throw your business in autopilot or take your foot off the gas. I know we all want to do that, and we've been waiting for 4 or 5 years to try and breathe that sigh of relief and return to baseline. But I just think, this is the new normal, and so you're going to want to make sure that you just, aren't taking it for granted, I think.
Yeah, that's a good way of putting it, Jordan. It's the new normal. I mean, we've seen from the MLS perspective, we even see a lot of changes to what was sort of institutional, chiseled into the granite. It would never change, and yet here we are dealing with changes. Tom knows from the product side, literally every year. Everyone that's out there in the audience, we've got great questions coming into the chat that Michelle's putting together. So please get your question in. But Tom, you had a follow-up question you wanted to put forward.
Well, actually, a question from the audience.
Oh, okay, awesome.
Question has to do with recently the president was saying that he might look at issuing publicly listing shares of government-backed mortgage giants Fannie and Freddie. What do you think the impact would be to real estate? Have you thought about that at all?
I think it's, going to be probably a negative from an interest rate standpoint and from a mortgage availability standpoint. Having the conservatorship on the GSEs gives a lot of certainty to mortgage originators that that I'm going to write this mortgage for you, and that there's going to be some buyer on the back end of this that's going to take it and warehouse it. And I'm not just going to be this giant portfolio kind of, United Home Loans kind of setup. And if it becomes private money, right, then it much more looks a lot like, portfolio lending. And I think that ultimately just means less availability of mortgages. When there's less appetite for mortgage-backed securities, it means those long-term rates stay higher longer. The interest rate on a 30-year fixed rate mortgage is like the inverse of the price of that mortgage-backed security. So less demand for that security, lower price, that means the rate stays higher. That's just math. That's not an opinion.
Okay. Yeah. Yeah.
So
Yeah, it's tough. It's tough. That's been on the chopping block for a long time. For me, it's hard to know where that falls on the priority list relative to trade and the tax package and all of that stuff. And I think they don't have unlimited political capital, so they're gonna have to pick and choose. I think the tax thing's probably a bigger deal, honestly. But like I said, the Fannie and Freddie have been on the chopping block for a while.
Another question that I've been wondering about, and if it shows up in any of your numbers, there was the ruling from NAR about no longer publishing commission, and the thought was you read all these articles about home prices will go down, commissions will go down. Is any of that reflected in the numbers at all?
No, nope,
Yeah.
not at all.
Okay.
And actually, it's not even happening. I think the fallacy was believing that it wasn't baked in originally, right? It was
Yeah.
always this way, right? This wasn't like somehow not part of, it was always part of the transaction, and nothing has really changed. And actually, I deliberately do not talk about settlement stuff. I think there was a lot of August 17th anxiety, like all anyone wanted to talk about last year up to August 17th was buyer rep stuff, and how I even got a ton of pushback on our membership forecast. Like, why aren't you slashing C.A.R's membership forecast? And, everyone's going to drop out of the business. And then August 17th came and went, and buyers are still buying and sellers are still selling and people are still getting paid and all that. So, to me, that is one of the things I'm not worried about.
Yeah. Yeah.
Like I said, I just sold a house actually end of last year, and you won't find, a real estate consumer out there who's like more in the weeds of this stuff than I am. Like oftentimes I go out and do these presentations with Gov Hutchinson, who's our like head lawyer guy on the form side. And so like I've personally done like 10 RPA training courses like this year alone. And like I tell you, I would not be able to do this transaction on either side. I wouldn't have been able to sell my house myself. I wouldn't have been able to buy my house myself. And that's for somebody that's super, dialed in on what you guys do. And so for me, I think that's like a real positive, but I just think it makes it therefore incumbent that you're one of those agents that has that whole bag of tricks, because it's not enough just to like get your license and let them find their own house on Zillow, and then you just let them fill out the form kind of a thing. It's like they really need us. So
Yeah. I'm wondering,
Absolutely.
Jordan, as you attended that barbecue on Memorial Day, your colleagues, your friends, your family know you're in the business. How is the consumer accepting the interest rate right now? Are they starting to, just come to the realization that, look, it's going to be six plus?
yeah.
Uh,
Yeah, I think people are sitting out there going, man, I really shouldn't have been waiting around the last 3 years because the interest rate hasn't changed at all, but prices are a lot higher now. And so, the house I can get today, it looks a lot worse than the one I could have got a few years ago. And I think the dots are starting to connect that the house you're going to be able to afford 5 years from now is going to look even worse, right? And so I think there's that. But then I think the current event stuff really scares people off, right? When you wake up and check your 401k and it's in the tank or something like that, then maybe you think like, oh my gosh, maybe I should just wait and see, right? And you kind of stop thinking long term. But I think the rate shock part is over, but it's just been now replaced with economic uncertainty.
right. People actually doing some math at home to figure out, is it feasible? Is it logical? That kind of stuff.
Yeah.
Consumer confidence. Tom, did you want to go there?
Well,
Because it's sort of the
yeah.
same
So
thing.
right, right. So, we know consumer confidence affects home buying.
Yeah.
But is there a difference between not buying a car or an appliance, versus a home? Like people sometimes have to move or they have to sell so, what are your thoughts on consumer confidence and how this is affecting the real estate market?
Yeah, I think it does affect the buy side, and for better or worse, you have a lot of people that are susceptible to, thinking cyclically about housing when it's really a long-term game, I think, but at the same time, like financial considerations are only one part because your house is like a necessity. It's like part of Maslow's hierarchy, whereas your BMW isn't, right? And all of that stuff. Um, that's why we're getting an uptick in supply. People were like, oh my gosh, we're never going to have any inventory ever again. We have all these people in a 3% interest rate. Like, why would you ever sell? You're never going to get a rate that cheap again. And even move into the same priced house at 7%, it costs you a lot more every month, right? To carry that around. And yet we see people moving and giving up those 3% interest rates, right? I sold my 1.5 acre property that I had a 3% mortgage on and moved into a, 1,600 square foot condo at 7%. And I have the exact same payment that I had on my big old giant house before, but and it's painful, but sometimes you got to move, right? Like life happens. In my case, I had a bunch of life changes that I had to move for. And, does it suck to give up the 3% rate? Yeah, but you got life happens, right? You got a baby,
Yeah,
wife gets a new boyfriend, something, you got to move.
yeah.
Yeah, I'm sure there are a lot of people, in the Pacific Palisades area that weren't expecting a move this year. And here they are, forced into it. I went through that during the 2020 fires up in the Santa Cruz Mountains of a lot of friends woke up and had to move,
Right.
kind of thing. Uh,
Yeah, no, I mean, like, unlike your Bitcoin, it also has the dual purpose of being your place to live too. And so it just like the finances are only one piece, unlike your Bitcoin, it's all financial.
right, right. Tom Rod came back with a follow-up question himself from the audience.
Oh,
And
Uh, oh, I didn't see
Yeah, I'll
it.
give it. So Rod's asking, so if you are more concerned about if the big beautiful tax bill passes, what's not in the news that may have a significant impact on the national debt increase, and how might that national debt increase impact the real estate marketplace?
yeah. No, great question. I personally don't care either way. That was my guess of what their priority is. Like that's not, I don't, I don't got a dog in the fight on that
Right.
for tax cut versus Fannie and Freddie stuff. But I do think that ultimately if the tax bill goes through in whatever shape, flavor it is, it's going on the company credit card essentially, right? That it's gonna be 3.5+ trillion that'll go into the national debt. And that impacts interest rates ultimately is I think how that shows up for us in
Okay.
real estate is that, ultimately these people that are buying these 30-year mortgage-backed securities want to know that we're not just going to inflate the value of that investment away by debt and deficit spending and just like devaluing the dollar going forward so that doesn't buy them as much when they ultimately get their money back 30 years from now. And that again feeds right into the current appetite for a mortgage-backed security, right? If you're worried that prices in 30 years are going to have gone up because we inflated away the debt a ton, then you don't buy the mortgage-backed security right now, and that means lower price, higher interest rate again. It's that same kind of causality there that, this is also a kind of repercussion of this stuff, right? That ultimately it just kind of makes it that much harder for long-term rates to come down.
Right. If you were to sort of apply that to those downsizing seniors out there who may be looking at Social Security going, boy, I sure hope it gets there. Um, I mean, impact there, could that be a segment that could be more heavily affected than others?
Yeah, I think so. I think older folks aren't moving anyway, and I think this just makes them kind of want to stay put that much more. It's pretty incredible in California how much of our like I talked about how we're not building enough, right? And so we don't
Right.
get a lot of the new stuff coming in to save the day, but then our existing housing stock is just locked up with all of these long-term homeowners that have Prop 13 super low property taxes. Their homes appreciated a ton, and so they're potentially looking at big, capital gains bills if they were to sell those houses in the Bay Area and LA and places like that. And that makes them want to stay put. And then I think, just this kind of prospect of higher long-term rates and all of that just makes them like that much more reluctant to move when they already aren't moving very much.
Right. May I
So,
ask?
so
Go ahead, Tom.
Prop 19, right, was
Mhm.
supposed to allow people to take their property tax base, right? And, but it hasn't moved the needle, right? It's
Yeah, it's tough because I think, you've taken away now the property tax penalty for people moving, which is good, but you still got, I think, the giant capital gains bill. People who bought their home in the 70s in Palo Alto for 70 grand, that's now worth $2.5 million. Like that's real. That's a big tax bill to move. And
yeah,
so even if you can keep that $70,000 property tax base and go move into your $3 million house, somewhere else you've still got to eat that capital gains. And so I think we're only halfway there in terms of eliminating or alleviating at least these kind of headwinds to moving on.
so you look at the entire state of California,
Mm.
um, but you mentioned Palo Alto,
Yeah.
and we focus on the Bay Area. We like to think we're special, um, and and so we still see some pretty high demand, in the Bay Area. Do you think the Bay Area is special? Do you?
Yeah, if you look at the median price in most parts of the Bay Area, it's pretty special. It's a pretty high cost area. And I think, it's got it's kind of the gem in California's economy with the tech sector and all these crazy high paying jobs and the growth that we've seen there and the wealth that's been created there and all of that stuff. I think it's that part makes it very unique and special in California, but I also think it's kind of unique and special in a pretty detrimental way in the sense that the Bay Area is some of the most resistant to new development. So you have this juxtaposition between like this powerhouse of an economy that's churning out all these high paying jobs, and we're even more prone to constrain housing supply. And what do you get when
Mm,
you have lots and lots of demand and even worse supply conditions than other parts of the state? You get a $2.5 million median home price, right? And so I
yeah.
think that's why even when rates doubled, rates went from three to even below three, they were like 2.85 at one point, all the way up to over 8%, virtually overnight by statistical standards. And like prices in the Bay Area barely budged, right? They're still up in the twos. So
Yeah, yeah.
So, Jordan, I was recently one of those homeowners in California who was told my insurance wasn't being canceled. I
mm,
simply lost coverage,
yeah.
which is like what? Let's call it what it is, kind of stuff. And so I went out shopping. It was not easy, but I'm hearing Michelle, put in my ear that common interest properties are also having insurance problems these days. I thought it was just me, Mr. Single Homeowner living in the mountains.
No,
Talk to
and
us about the common interest situation relating to insurance.
yeah, I mean, insurance is big and ongoing challenge for all residential. You're seeing HOAs do well, just in my own personal experience on that big house, one of the main reasons, well, besides my personal stuff, I sold it because of insurance issues too. When I moved in 17, I think I was paying like 900 bucks a year or something like that. And then in 20, it went up to like 3 grand a year. And then in
Wow.
22, it went up to 13 grand a year. And in 23, I got dropped, and then in 24, I dumped the property. That those are not, going from 900 to 13,000 is like thousands of percent increase, right?
Right.
That's like $1,000 a month is real money, for people on top of a mortgage payment and things like that. You can kind of extrapolate that out to the condos. But the challenge for condos is, like for me as Mr. Individual Owner Occupant Homeowner, I can choose to either, pay the 13 grand or dump it and move and let it be somebody else's problem. HOAs kind of have, restrictions on how much they can jack up HOA dues, right? So then they go into like these deficit spending type stuff to keep up with their insurance payments, but then they have
Right.
reserve requirements, right? And so you see people in these HOAs going from 80 bucks to 400 or 500 bucks a month, right? And they're all of a sudden now can't afford. So I think it impacts demand, right? Because then it's just like the next buyer for that's got to bake in the new HOA dues. And
Right.
also the HOAs they might not be able to raise dues fast enough because of the statutory limits and all of that stuff to, you know, avoid going into real like financial stress too. So I
Right.
think it's a problem
Well,
all over the board. And I think it's probably going to keep getting more expensive too.
yeah, and then you look at those special assessments that come, right, that just, take those senior citizens and blow their little budgets right out of the water.
Yeah. I
Uh,
mean, when you're on a fixed income going from 90 bucks a month to 500 is a big deal.
yeah, absolutely. Uh,
So, Jordan, we've been talking a lot about uncertainty, right?
mm,
And uncertainty with the economy and stocks and insurance. Do you have any thoughts about how agents should talk to their clients about the current market? Like,
Yeah, I think housing is a long-term game. I think, again, you look at the kind of stats on wealth in this country, right? I think the typical family in the United States, as of the most recent data, had about 195 grand in net worth, right? You add up all the assets, you add up all the liabilities, difference between the two is about $195,000. But what's crazy is that if you separate that out and look at homeowners from renters, the renters today are just as poor in real terms as they were 30 years ago. And so you have all these kind of conventional wisdom type articles that I get sent like, oh, just stay renting and invest, buy a S&P index fund and do that, right?
yeah,
Like you accumulate, you'll be just as well off as if you bought a house and stayed in it for 20 years and all that. That stuff never happens. The other thing is, California home prices really barring some kind of economic catastrophe can really only ever go one way. Again, we used to build 300,000 homes a year when we were a 20 million person state, and we now build 100,000 homes a year and we're a 40 million person state. So like we have effectively commoditized the housing market. It's like, the California housing market's like a Taylor Swift concert, right? Like the arena seats like 10,000, but you got 50,000 screaming teenage girls out. And that's why you get the scalpers walking up and down selling the tickets at 7, 8 times face value. It's because it's just a fundamental econ 101 thing. And I think, you get on board and get in as soon as you can, or you get left in the dust. And that's pretty much been the tail of the tape for the last 30 years. And so while we've been like trying to time the market, you're like every year that goes by, you're less able to get your foot on the property ladder. And I think just again, like mess around timing the market with your Robinhood account or whatever, right? Like that's not what
Yeah.
housing is for. You got to like, find me another investment. You got to buy a lot of gold if you want to live in it too, right? Like, so it's not just the financial component.
It used to be, Jordan, that you hear these stories of my job is in Sunnyvale, but I'm living in Tracy. I'm living out in the Central Valley and I'm doing the 2 hour commute each way. But then that price, that $1 million price, I think has reached Tracy. But
Yeah. No,
um,
exactly. They're going to have to go even further afield. You got to go out to like Tuolumne County and stuff to like
wow,
commute into the Bay Area to, right? Like yeah, and I think that's returning, right? I think that kind of took a little bit of a pause, like that um, commute driven out migration to places like Tracy and Stanislaus and Modesto and stuff like that, and Sacramento and Yolo and Davis and all of that.
right,
Because you didn't have to go to work. And so you had a bunch of people that went all the even further. They went to Tahoe and went to Mammoth and just got a cabin in the woods and all that stuff. You're starting to see, and the employers want the people back to the office. So it's just a matter of time. Once, right now, workers are kind of in the driver's seat because unemployment's so low that employers really can't force them back to the office. But as soon as unemployment goes up and you're like, oh my gosh, I can't find a job and I got bills to pay, going back to the office doesn't seem so bad, right? So I think
right.
as soon as the economy changes, and then you're going to see that return of that commute driven, right? You want 1 foot into the Bay Area for your job, but you can't afford to live there. So you got to look, further east.
Yeah. Where are those flying cars they promised us?
No,
God.
even south. I mean, you go down to San Benito County and stuff, and like you get people commuting in from there to the Bay Area
Yeah.
too in
We
multiple hours. So,
Tom as an employee, a fellow, staff member who does just that.
yeah.
Granted, he works from home, but Jeffrey comes to the office pretty frequently that I
Right.
see.
But it's worth it, instead of paying 2 million bucks, you get a bigger house and whatever, and you worth some time in the car, I guess.
Got it. Hey, Tom, I think we're ready for the lightning round.
Okay.
Yeah,
So
that's what
Jordan,
which I got
uh,
the orders from Michelle. So that's,
okay.
Jordan knows Michelle. We go with
Big
what she
fan.
says.
Oh yeah.
Okay, so the lightning round, Jordan, is we just have some questions that, we're looking for a yes, no. Just, off the top of your head, if you want to comment on it, that's awesome. But here's the first question. Will we have a recession in 2025?
No, for now. Reserve the right to change it though.
Okay. Will the Fed decrease the federal funds rate, resulting in sub 6% mortgage lending in 2025?
Yes, they'll probably still give us a rate cut potentially. No, it won't give a sub 6% mortgage rate though. Those are not connected.
Okay. Will we see an increase of Bay Area buyers backing off of home purchases?
I think you have already seen the cold foot effect start to take root and get people, press and pause and sitting on the sidelines. But I will say that, it's a very I talked about California in general being very stock market driven. The Bay Area is even more so,
Right.
sensitive to stock market changes. So if we do
Yeah.
permanently press pause on the trade war and we, avoid some of these worst case scenarios, I could see, exuberance returning to the stock market and making the Bay Area outperform in the second half of the year. But it just depends on what we do on these kind of choice variables on the political level.
Okay. Next question. Will economic policy from the current administration result in an increase in Bay Area job losses?
Possibly. I think, if we keep going with the trade war and the stock market corrects, that impacts the Bay Area, specifically because you got a lot of publicly traded companies. You got a lot of publicly traded companies that funnel money venture capital wise into new growth startups and all of that kind of stuff. And if the, economy dries up and the stock market corrects, then you have Bay Area companies that are exposed to financial markets, right? They're really, that's the bread and butter of a lot of these tech companies, right? Is like what goes on. They live and die by the financial markets. And if we got into a recession, if the stock market had a deep correction by, 20-30%, you would see job losses in the Bay Area and probably, across most of California.
So, if we see job losses or less new hires for Bay Area companies, will that decrease migration to Northern California and result in decreased demand for housing in the area?
I think it could, right? Like the saving grace for the Bay Area is in its housing affordability. Like people are there in spite of how unaffordable it is because of access to all these great jobs and things like that and experience
Yeah.
and potential to accumulate wealth. And so if that dries up, then now you're looking at not a lot of job opportunities and super unaffordable housing. And that's kind of, that's why the Bay Area is susceptible to economic downturns is because these prices are supported by, this kind of gangbusters economy. And when that goes away, then you've got homes that are pretty high above the typical family's income there.
Um, the weaker dollar,
Mhm.
does that mean greater foreign investment in Bay Area real estate? Uh,
Yeah, I think that helps, right? When the dollar is weak, that's good for foreign inflows of capital. But I think even more so than whatever the dollar does, like the Bay Area still and California in general is still seen very positively by the rest of the world. And one of the positive byproducts of all of this wealth being accumulated in these BRICS countries and really everywhere is that they like investing in the United States. It's not just the dollar being strong, right? If you're worried about your own domestic economic shenanigans and like your own government blowing things up at home, then even if the dollar doesn't right, even if your asset, even if the house in the Bay Area doesn't go up a ton, if your own economy implodes and you can change that back over into rupees or yuan or whatever, and you just made a boatload of money. And so that like I think safe haven aspect of the US residential real estate market is like very alive and well for the Bay Area in particular, because it's kind of got that prestige factor for the rest, for the rest of the world beyond just being a safe haven too.
okay. So, is there a scenario in which you see that the recently enacted policies and tariffs would ultimately lead to a long-term boom for California and for the Bay Area?
No. Uh,
Yeah.
No, I think, I believe in comparative advantage and doing, we all benefit by focusing on the stuff, right? Like it's better for me to focus on doing economics and being good at spreadsheets and then letting, KB Homes do the home construction, right? Like I don't need to go out and do the spreadsheet and grow my corn and, drill my own well for water and all that. Like I'm better off by doing what I'm good at and letting the well driller do what he's good at, right? And let the doctor do what she's good at and all of that stuff. Like I kind of apply that same logic to, internet. Like I don't run balanced trade with every trading partner I have, right? Like I don't go to
Right.
Vaughn's and run balanced trade and go like mop in the back to pay for my groceries. Like I'm unbalanced there. And I run a huge trade surplus with C.A.R. So,
Right.
it's so to me, I think that's if we could produce it cheaper and higher quality, we would already be doing that. Like if Ford could make Fords here better and cheaper, they already have an incentive to do it the cheapest, best, and they made that choice. So,
Yeah. Um, Final question. Uh, Mexican food or Italian food?
oh, I'm from San Diego. It's Mexican food all the way, but with the
Nice.
caveat that it's
Yeah.
San Diego Mexican food. I'm sorry, everywhere else in California, you guys are
But
second place, a distant second.
San Diego has Little Italy, though, right? So,
It does, yeah, but you're
yeah,
still better off going to Lolitas and get yourself a carne asada burrito.
I was gonna
I,
say anywhere you
I
go.
agree. Yeah, yeah.
Absolutely. Um,
Mark,
yeah,
yeah,
Michelle's coming with maybe a wrap-up question, but I want to talk just a little bit about supply, and I'm actually going to read her question. You aren't expecting significant increases in supply. Has there been any change due to the ADU
Mm.
regulation changes that are affecting, the housing market to the positive?
It is a positive, and that is, it's a positive. It's accounted for almost all of the uptick. Like we pretty much only ever have built 100,000 homes, give or take, for the last like 5, 10 years. The last couple that's ramped up to about 120, 130, and almost all of that uptick is ADUs. So that's a huge positive because we need any kind of housing, all the above, low price, high price, all the way
Right.
up and down the spectrum. The problem is it's still only 20,000 or so units, and we've got multiple million unit deficit that we gotta, right? So it's
Right.
still
We got a big number to hit. Absolutely.
right. So it's helping, right? But it's not the silver bullet. We just need that plus, plus, plus every other kind.
Good. Are you noting, we had City of San Jose, and I think the City of Santa Cruz has brought on policy that says you can sell your ADU and the property that it's sitting on as a separate, basically parcel. Are you seeing
Yeah.
that adoption, being adopted?
We haven't seen a lot of ADU kind of subdivided ADU sell-offs. That'd be a cool thing to track in the MLS, right? Is like, was it a subdivide? I don't know how you would do that, but the challenge and why I think even the ADU numbers themselves are pretty small. We're only doing 20, 30,000 of them a year is like there's not a really great financing mechanism. So you're either relying on somebody who's been there for a long time that can take out a HELOC or
Right.
somebody camped out on a bunch of cash that they can do it with. Otherwise, it's hard to find loan products or like there's no good rental site where you can see what does an ADU rent for. Like on you buy an investment property, you can say, here's what a single family rents for, and you can count that towards the
Right.
mortgage and all that, right? Like, so it's just that's why it's limited in scope.
Well, I know that, in the case of Santa Cruz County where I live, yes, yep, you can put an ADU with no lot clearance. Yes, you can subdivide it off, but wait till you go through the permit process.
Yeah, and it still costs a lot. You still got to find a contractor who's going to come build it for you, right? And all of that
Right.
stuff too. So,
Um,
So,
Tom, you had a question, I think, on
another,
flipping.
yeah, a question from the audience about flipping. So they're saying they're getting, lots of text emails about people who want to find a distressed property and flip it. Is that something that you're seeing up and down
I
the
mean,
state?
the flippers are, out there flipping, but they're not flipping distressed properties. 98% of California mortgages are being paid on time. There just isn't a lot of distressed units out there. And I think part of the reason is because people are on these sweetheart mortgage rates that like you're keeping that's your highest financial priority is keeping that mortgage going and alive and well. And like you will let a lot of stuff go before that mortgage because it's, rents are no picnic. You can't go, save money by going somewhere else. If you leave your 3% mortgage, it is going to cost you more money. And so people are, holding on to those things at all costs. And I think you'll continue to see that incentive be there just because, again, moving anywhere else costs you a lot.
Okay. So, Mark, I think we're at
Yeah,
the
right.
final
Yeah.
question.
Yeah, well,
Uh,
sort of a final question. Definitely the market's in flux. I mean, that's the title of this meeting, this session of markets in flux. Um, That being the case, what's the data that our subscriber, the professional real estate agent, should be looking at? And then how do you see the rest of the year wrapping up? Any Jordan crystal ball insights?
Yeah, I think more bumps in the road, right? We're going to get to this
Okay.
90-day thing and there's going to be volatility one way or another. Either we'll reignite it and things will go down or we're going to cancel it or pause it again and people will get really excited. So they're just the moral of the story is lots of ongoing volatility, but probably still growth. I think when you ask what to look at, if you look at the honest to goodness, like not psychological indicators, jobs, income, consumer spending, right? All of those things have not deteriorated. So that's why I kind of called my thing the signal versus the noise. Lots and lots of noise out there, but the underlying signals on the economy, like we're at full employment, GDP is essentially at an all-time high level, and same with everything else. So like keep perspective. There's a lot of negative headlines, but it always makes sense to own as much real estate in California as you can, right? And all of that stuff. And the housing is a long-term game. Show them the wealth numbers and just ask, do you want to be on the rental line or the owner line? Because,
Right.
one set of people has money and the other one doesn't.
Mhm. It's sort of, you really got to lay it on the line these days.
Keep it simple,
Yeah.
cleave to a couple of key indicators that it's hard to argue with. Unemployment's 4%.
Yep. Exactly. Our viewers are typing in. They're really enjoying this session. This session with you, Jordan, is very, very informative. They're asking
Awesome.
about the slides
Oh
and
yeah, I'll send these to Michelle right after I get off here so you guys.
okay. And anything cool over on the C.A.R. site that you want to let everyone know about if they haven't visited there in a while?
Well, if you ever miss me, we do a podcast every couple of weeks where we talk about like whatever's current and
Okay.
topical at the time. We're doing cool stuff with the forums, like kind of cold foot indexes and stuff to see like, is there any way we can kind of get a beat so that we do, not get caught with our pants down or get surprised down the road to the extent possible. But yeah, there's a treasure trove of all kinds of cool stuff. And I work for the agents. I'm proud to help them, however. So if there's stuff that they need or, if we can partner with you guys on anything, I'm happy to do it because when we put more people in homes, then I'm super happy. So
Yeah, you are the housing guy. Hey, one time, speaking of housing, can I afford a home? You've got an affordability app, right?
yeah, yeah,
Is
we
that
have a
still up and
great,
running?
we do. It's called the Purchase Power Calculator.
There
It's a
you go.
great tool to go and show people like, what happens the longer you wait, right? Or like, we were using it back in the day when rates were 3% saying don't wait for them to go to 7 because look how much less you qualify for, but you can do the same thing in reverse. So I
Right.
think yeah, there's a lot of really cool stuff up there.
CAR.org.com.
C.A.R.org and my
.org.
spot is it's called like Industry 360 or something. I didn't make the website, but
Cool. Tom, any last minute words of wisdom or observation?
I just want to take a minute to thank Jordan for spending this much time with us. It's been fantastic and
Yeah.
super helpful.
Yeah.
Yeah.
no, I really appreciate you having me. Shout out to my friend Michelle too. I'm a big fan. You guys are very lucky to have her on board.
Yeah,
So
we certainly are. Certainly are. Jordan, we hope we see you next year about this time. And we'll see where we're going.
100%. Thank you guys so much.
Good. You bet. Talk to you
Thank
soon,
you.
Jordan. Thank you.
All right, see
See
you.
ya.
Make sure to check out our pro support page for additional videos on a full range of topics. And don't forget to click that subscribe button on our MLS Listings YouTube page.